Thank you very much, everyone, for joining this call. Good afternoon, and welcome to the ReachX webinar on the implications of the crisis for credit markets. My name is Mathieu Jarvis, and for those of you who don't know us well yet, ReachX is an FCA-regulated platform offering investment banking advisory, research, and origination services through its curated network of senior independent finance professionals. We help both institutional investors and corporate clients to source, research, analyze investment opportunities, and also raise capital. Today, I'm very happy to host three senior ReachX advisors who will discuss their views on the impact of the crisis on global credit markets. Our first speaker, GJ Prasad, will discuss what steps the central banks have taken so far, their monetary implication, and the potential impact of the crisis on European banks. GJ is a senior financial research strategist and portfolio manager, specializing in bank capital and liquid credit macro. GJ has significant expertise in bank capital instruments, having covered the asset class for more than 15 years as an analyst and 7 years as a risk taker in buy-side roles at BNP Paribas, BAMO, JP Morgan, Millennium, and Caxton. Then we will hear from Eugene Regis, who will cover the loan market and implication for private assets on potentially 2 or 3 quarters with little cash flows. Eugene will argue whether this will prove the flexibility of cov-lite loans with less covenants to breach, but low recoveries if they do end up defaulting. Eugene is a high yield and leverage finance credit strategist with over 20 years of experience at Barclays and MUFJ. Eugene was also a member of MUFJ's credit portfolio management team, which managed and hedged a €100 billion portfolio. Finally, Raphael Kassin will share his views on the implication of the crisis for emerging markets. Raphael is an experienced global emerging market fixed income portfolio manager. Over the last 30 years, he has managed hard currency and local assets in both sovereign and corporate bonds at ABN AMRO and Credit Suisse Asset Management, amongst others. We're going to try to keep this session to around 45-50 minutes. As you can see, all the participants will be on mute during the presentation, and we will open for questions after each speaker. So if you want to ask a question, please click on the participant window and raise your hand, and I will unmute you. Thank you also for introducing yourself before asking the question. So without further ado, GJ, where are we in terms of monetary accommodation, and what does it mean for credit?
Thanks, Matthew. Thanks for organizing the call. Right, that's an interesting question. The G4 central banks have carried out extraordinary monetary accommodation in recent weeks. That has included rate cuts, additional TE programs, and they have reopened many of the GFC-era crisis lending programs that has offered significant liquidity to the system. In particular, the Fed and to some extent the Bank of England have been extraordinarily quick and very supportive to ease liquidity conditions across asset classes. The Fed, Bank of England, ECB have now included IG corporate bonds, and in the case of the Fed, corporate bond ETFs in the QE program. And this has helped to reduce the strains in the secondary trading markets and opened up the primary markets for a number of high-quality issuers. But that has come at a cost, as seen and reflected in the new issue premium being paid by issuers, and also significant repricing of existing secondary paper. Whilst the various programs have helped to address liquidity issues and proper market functioning, in my opinion, they are unlikely to have a significant impact on overall risk sentiment for credit markets for the time being, as fear factor is still very high, given the uncertainty about the impact of the economic downturn from the health crisis, both in terms of length and also in terms of severity. The monetary accommodation and various programs do well on the margins and ensure capital markets are open for the very best issuers for the time being. As far as the banks are concerned, the central bank programs in terms of repo facilities, TAT, LTRO, other term lending facilities should obviously help them access additional liquidity if needed. And it seems that some of the biggest banks in Europe and obviously in the US with very good fundamentals have been able to issue senior and secured debt. At this point in time, it seems there's very little appetite for capital instruments. Based on what I said before, in the last couple of weeks, some of the themes seem to be working very well in credit. which is ongoing decompression between IG and high yield, especially in cash bonds, senior versus subordinated debt spreads, and obviously decompression in core versus periphery, and has helped people to own short-dated and highly rated IG paper and anything that is QE eligible. And it seems that having cash to participate in new issues with significant new issue premium seems to be the way forward.
Okay, thank you for this good introduction. So what else can the central banks do, especially for credit?
I think leading from the Fed, it seems that the Fed wants to get involved in ensuring credit going into the economy and into corporates and SMEs. It seems that the Fed is going to get involved in direct lending to corporates from the program, from the plan that was approved by Congress last week. I think a central bank guaranteed wrapper is probably the next thing that may happen, that may be made available to corporates and SME. It remains to be seen if this facility, which I call a corporate guarantee wrapper, whether they'll be secured and whether it will be super senior to existing debt. I also think that BOE and ECB will probably offer even more longer dated term financing to the banks and potentially to other financial intermediaries to keep credit flowing and to take measures to ensure that secured markets like covered bonds, asset-backed securitization, especially RMBS and CMBS vehicles are functioning adequately. And if the liquidity situation does get worse and financial conditions tighten furthermore, both the Bank of England and ECB may expand the corporate bond program to include, in my opinion, senior preferred debt issued by the banks or opco debt issued by the banks, and also launch a direct lending program to non-investment grade issuers as well. In summary, we should expect significant expansion of the various programs with the central bank balance sheets expected to expand rapidly and to levels not seen even during the great financial crisis.
Thank you very much. Well, that's very interesting. So what do you think will be the impact of the crisis on European banks then? I mean, if you can list them.
Obviously, we've seen the reaction already both in stock prices and also obviously in debt. Clearly, investors are very anxious about both the direct and indirect impact of the measures that have been taken and what it means to their business model. But to be more specific, I think we could probably look at 10 areas or 10 headers in terms of direct impact. Clearly, on the revenue side, we should see further net interest margin compression, declining fee income, volatile trading gains and losses. A second thing would be the ability to restructure on the operational costs is going to be limited given the backlash that's going to come from both the political side and the regulatory side. I expect a big increase in realized loan losses. Obviously, we've been very used to low levels of credit losses, but I think we should expect as high as 200 basis of loans in some cases, and clearly a big spike in non-performing loans, potentially to high single digits or even double digits. I would then go on to say, the regulatory pressure to keep credit flowing, and that may lead up to potentially an economic loan books. But at this point in time, given the regulatory pressure to ensure credit flowing, that's something to keep an eye on. All of that translates to, in my opinion, very low ROE. I would think that most of the banks probably are going to report ROEs in the range between 1% to 3% at best. And the cost of capital is going to go up as this premium is going to get factored in. I think there's going to be a very sharp divergence between the top 15 banks in Europe and the rest of them. We should see continuing deleveraging when the opportunity presents, not now. And in some cases, especially in periphery, we should see more sovereign debt getting onto the balance sheet, both for LCR purposes, also to support the domestic sovereign. And we should expect reduced cross-border activity in terms of trade flows.
Okay, thank you very much for that. So what events and catalysts are we looking at for?
Obviously, all the 10 points that I mentioned are things to look out for, and I think that would be the direct impact. The secondary impact catalyst that one need to look out for would be things like deposit flights from peripheral banks, especially second-tier and third-tier banks. Obviously, if there are going to be bigger sovereign defaults, especially in Latin America and in Asia, what does it do to the balance sheets of some of the European banks with large operations in that part of the world? We need to keep an eye on the capital and intergroup funding that is trapped in overseas subsidiaries for some of the European banks. And finally, what happens to the rollover of maturing debt, especially taken during the previous TLTRO funding from the ECB.
Thank you, GJ. One market that you follow closely, as some of your followers know, is the AT1 market. So what happened to the AT1 universe and why did the prices fall so dramatically?
That's been a very interesting market to follow. Clearly, to some extent, the AT1 market has not correlated with anything, be it equity or credit. In fact, it's done worse than both. The high-yielding section of the credit market, AT1 and sub-debt, had been the investor's choice of interest for a long period of time due to the decade-long era of low rates. And what has happened is that part of that trade solve, investors play, they help their part in recapitalizing the banking sector. They're lured in by the plentiful yield that was on offer. But now, what has happened is the AT1 segment has been hit more due to liquidity and momentum factors, and it's increasingly becoming technical in terms of who's holding it, and driven by headline risk and everything else. Valuation don't seem to matter. Just looking at the performance of AT1s issued by the European banks for the last 6 weeks, it's clear that a large portion of the performance seems to be in certain names that has been driven by idiosyncratic stories, themes, which resonate with periphery risk, low reset coupons, restructuring story, and potential ability to pay coupons. And in my universe, just looking at, there are significant relative value opportunities that are thrown up, but finding the right instrument and finding the right structures seems to be the challenge. While fundamentals are important, it seems that the market is now driven more by technicals. I think the real issues over here are the risk premium that people want to attach for default risk that has not been calibrated properly, and also the lack of secondary market for participants to exit. And adding to that, the complexity caused by the growth in ETFs, and more so in credit products, which are inherently illiquid.
Okay, so in your space, is there an opportunity set that investors can look at or take advantage of?
Yes, I think so. I think it's all about single names selection. At this stage, we're not going to go into specific names or specific issues, but I think we could kind of come up with a criteria with a short list of names that one would want to own. That would include a business model that is easy to understand, which has got good visibility on both earnings and asset quality, a superior risk management framework reflected in quality and consistency of earnings over a longer period of time, and credit underwriting over the economic cycle. Looking at solid capitalization, both at on an absolute and relative basis, especially in the leverage metrics, and low stock of NPLs and good reserve coverage. Banks which are self-sufficient in funding have very little reliance on wholesale sources, especially central bank funding. And I think ROEs that are potentially closer to the issuer's cost of equity, and AT1 yielding significantly higher than dividend yield, and AT1 coupons which are not at risk under most severe stress scenarios. That would be the kind of framework that I would go with to then come up with a short list of names to own and issues to own.
Okay, to wrap up your one last question maybe from me, and then we'll open it up to the audience. But why is bank capital so attractive to own for long-term investors?
Right. Obviously, there are a number of issues in this segment that people need to look at. But having said that, there are a number of issues out there that are looking very attractive to own for long-term investors. The question of liquidity as to who's going to be the marginal buyer of AT1s in size and what is the clearing level for that. But I think over time, once the dust settles, I think the market will find its way. And AT1 that are yielding double digits on a yield to call basis and close to, let's say, 8 or 9% on yield to perpetuity basis, I think should find decent interest. Believe that there will be specialist bank capital funds, district debt shops, and private equity firms that will want to own this paper, but as a price taker. This asset class needs a certain type of deep pocket investor with locked-in capital, and who's prepared to do the necessary deep dive work both at the issuer level and issue level, and be able to slice and dice the balance sheet to estimate asset recovery values. Having said that, finally, those have the ability to stomach the volatility as the markets prices from one tail to another. But once once the above factors are taken into consideration, I think this asset class is still presents significant opportunity for the long-term investor.
Okay, thank you very much, GJ. I think we're just going to give it a few minutes, a few seconds to see if anyone in the audience wants to ask a question at this stage. So if you go on the participant window on Zoom, you can actually raise, if you click next to your name, you can raise your hand. I will see that and then I will unmute you. Again, if you can introduce yourself before you ask the question, that would be great. So let's just give it a few minutes to see if someone has any questions, but with a presentation that was so deep and interesting, I think you already covered a lot of points. No. Okay, so let's move on. Maybe. Thank you very much, GJ. I really appreciate your presentation. I'm sure so did our participants. Moving on to the loan market now with Eugene Regis. Eugene, we hosted you last year to discuss the implications of the rise of covenant-lite transactions. So now, do you think that more cov-lite issuance will translate into more defaults?
Hi, Matthew. Thanks for hosting me. So what's happening now is such a financial shock outside many investor and sponsor models that you've got to think that a lot of names in this universe will see at least 18 weeks of little to no revenues. So if I put it simply, if I take a walk on my high street coming out of self-isolation, I can see that a lot of businesses have closed down for this period, and some are able to innovate, like deliver food and keep going with getting some revenues. But for others, you've got to think you're adding a stack of leverage onto your chain restaurant or the cinema whose loan's been packaged into a CLO or has a bond outstanding, and you've got to think, can this business survive with little to no revenue for this period when it has to service its debts? So how has the default risk in this business been repriced? And that's important because in the European loan market in particular, cov-lite paper now represented about 80% of primary issuance going into 2019, and also more high-yield bond paper was issued with less covenants and has less disclosures like password protected websites. So clearly investors have less rights to protect themselves going forward in a cycle like this. If you're asking me, are cov-lite loans the concern, or is the erosion of maintenance covenants the real concern? I feel that this shock is so big that whether a business has covenants or not doesn't matter so much. Now, cov-lite has, you could argue, has an advantage over issues sold with covenants because a business with more covenants has more triggers to trip. You can see a default happen earlier, and a business that with covenants has more time to recover and eventually reduce its cost of capital. With cov-lites, obviously, if defaults occur, they tend to be further down the line with lower recoveries, and if a company had more covenants to breach. And this is important because in a recent S&P study, they showed that recoveries of cohorts borrowing after 2010 for cov-lite deals were lower than those issuing before 2010. So as the standard of covenants continues to erode and you get less and less, when cov-lite companies default, your recoveries will be much lower. This compares to higher recoveries for all bank loans and senior secured bonds. Now, there's the big argument that the boosters put out that more cov-lite deals doesn't equal more defaults because there are fewer triggers. What it results in is more zombie credits instead. Now, the zombie credits are the financially underperforming names with over-levered capital structures, and there's little chance of them achieving the top-line growth. They need to reduce leverage with fewer triggers for default. But again, this period is so exceptional. These companies are going to be seeing about 18 weeks of no revenue or little to no revenue, and people have not counted on this. So I expect more defaults and less warning on them. The zombie stage will actually get skipped. The only counterpoint to this is that sponsors and lenders will have to act with more flexibility because these securities were sold without an assumption of a global pandemic killing their revenue base, the sponsors and lenders won't want the portfolio companies to go bust. So there is the flexibility to remodel portfolio companies so that all stakeholders take some pain. And this will include some names which were over-levered going into this, and some names which will end up going to the wall to save more viable names. Issuers with more covenants will have to work this out more publicly, cov-lite instruments less so, and I'll talk more about that later. Hello?
Okay, yeah, so, sorry, thank you very much. So what do you expect the defaults to go from here then?
Yeah, so firstly, it's important to say that covenants give rights. So cov-lites may give sponsors more flexibility to restructure their portfolio credits, but that means a restructuring over which the creditors have little say, which adversely affects their rights. So I think what could have more impact on recoveries is increasing secured leverage since the last crisis, because before 2008, secured bonds didn't exist. Most structures had unsecured, high yield, under a loan, or were all loan. So we've got these much higher secured leverage points which stretch senior deals without any buffer above the equity charge to take the first loss. So it's going to be a question of recoveries. Where do I expect defaults to go? I think the obvious answer is it is higher, but that's an oxymoron. I think the peak in the last financial crisis in the European Leveraged Loan Index for defaults was about 10%. It becomes the path at which they increase. So agency downgrades, whether it's for private ratings or for credits with public ratings, will become multi-notch as the agencies catch up. So double Bs will become single Bs, and single Bs triple Cs, and triple Cs possibly default. The agencies may look at buying the argument at giving names time, but this is unprecedented. A lot of these names, remember, are highly levered, and they can't afford to have little to no revenue for this longer period. It is possible that some defaults can be mitigated if sponsors take action to buy back the debt to their portfolio credits and cancel it, but it has to be on credits that they think are worth saving. Also, this may break the transfer restrictions on debt if cov-lite transactions actually have this in their documentation. So I'd expect defaults to be higher, but it is going to be about the rate at which they increase. And if you were to ask me to put a number on it, so I think 10% was the last peak. I'd say between up a band of 15 to 20%, because there is flexibility that sponsors can do to take on action on saving credits. In terms of other special cases, we are going to see more energy names default in the US. Energy names are about 11% of the high yield index that BAML uses. And even though the last fall in price in 2016 gave them the chance to reduce the break-evens they need on their price of oil after bankruptcy for these shale credits, it may not be enough if the WTI benchmark stays at around the $20 a barrel mark. So, I do expect more defaults there, and indeed the market has been pricing that in.
Okay, well that actually brings on a lot of further questions. And I'll list them maybe 2 or 3 questions you can probably address at the same time. So the first one is, if we do see a rise in defaults, which covenants will be most likely to be reinstated? Or has the genie gotten out of the bottle and documentation will remain loose, in your point? My second question would be, how much does weak language impact recoveries? And finally, more importantly, how vigilant do investors need to be, right? Should they have a shadow maintenance covenant to effectively monitor creditworthiness, or should they take a more conservative approach in investments, i.e. only invest in companies where cash flow is less variable?
Yeah, so we had a market before this where the power had moved over too far to the seller and the buyers were talking of pushing back. Recently, over the course of the past 12 to 18 months, buyers had formed their own European Leveraged Finance Association, which was pushing for greater investor protections. Now, if defaults rise, I'd expect actually that there'll be more disclosure for investors, this trend to actually continue. And at the most basic level, it would mean more reporting covenants, more shadow covenants, and less things like password protected websites. Investors will at least be able to find it easier to monitor their investments. Weak language, I think an obvious example will be the negative pledge covenant. So assets that were in an entity that were part of a structure, may not actually be in the entity that was pledged as collateral to bondholders, leading to a lower recovery of default. So I think this situation of what we're seeing now will accelerate a move towards greater investor protections and cleaner documentations. And actually, the push will come from both the high yield and loan buyers as well, but also even in investment grades, you're seeing buyers of investment grade debt now face structural subordination. So, for example, Carnival Cruises is looking at issuing a secured bond, which would effectively subordinate investors of its unsecured bonds. And this is, for investment grade holders, welcome to our world. This is something that has always happened in high yield, and it's now happening in the investment grade market. I would argue that more protections won't ever stop defaults happening, but it will put this episode is going to put investors in a better position to demand more, because it's a great test of how cov-lite actually works and what sort of recoveries you end up with. If you end up in a market where recoveries have been crushed because of the lack of investor rights has come home to roost, then I think if you want people or investors to actually start buying into offerings or buying into restructured credits, more importantly, after this crisis is over, then you will need to then sponsors will have to give investors more rights than they're getting at the moment.
Cool. Thank you very much, Eugene, for all those insights. Again, I would like to offer our attendants the opportunity to ask any questions. So if anybody wants to ask Eugene a question, please raise your electronic hand, and I will let you in the room before we move on to the third part of our presentation today on emerging markets. Eugene, I think you've been very thorough again, and no one seems to be asking questions. So thank you very much for your time. I really appreciate your intervention. Thank you. Moving on to the last and third part of the presentation, just wanted to introduce again Raphael Kassin. Raphael, thank you for joining us today. So emerging markets, how do you think emerging markets will be affected by this current crisis?
Well, Mathieu, thanks very much for the intro. Well, look, it's very complex. I think I'd like to do a summary that everybody already knows. This is essentially a global crisis, obviously because of the virus. Before this happened, it looked like there was a lot of complacency in the world. Markets were all hot, and all kinds of strategies were I guess, being sold, including private equity transactions that would never, in normal conditions, happen. So, in a way, actually, this is an interesting shakeup. The epicenter of this crisis is definitely in developed markets, but it's spreading to emerging markets, right? I mean, it happened in China. China is not an emerging market. And there is an additional factor in this crisis that complicates things, right? Which is the oil spat between Russia and Saudi. Had it not been for that, this would be a much simpler transaction, if you can call it that. How did emerging markets, or how will emerging market countries be affected by this crisis, right? You can do your analysis for developed markets, but I think it's important to understand that it will all trickle down to emerging countries. The first obvious effect is going to be contagions, right? So we're going to have population that's going to be sick. People are going to not go to work. And if they have lockdowns, there will be economic contraction, right? There will also be the usual export revenue shortfall. If developed markets are not consuming that much, if we have a period in which during which the world is shut down and they're not buying things, or including oil, then obviously there will be issues with countries that depend on export. And there are lots of them. And then there are also countries that will have their ability to service the debt hindered, obviously because they depend on foreign currency in order to repay the debt. And if they're not making money, well, obviously there will be issues with that. We've seen some of these, some of the effects of the crisis happen attacking bonds already. You know, markets these days move very quickly. We've had record levels in fund outflows, and I'm sure there are people in the audience who have funds and they probably have seen the outflows. I've heard of gigantic numbers. And that's something that has to be dealt with. It's a technical issue that eventually leads to lower prices. It's very obvious, right? We do have an issue that is interesting. Emerging debt last year had a fantastic year, not as good as U.S. equities, but it did fairly well, especially in dollars. We had roughly 30% returns. Now, that means that you're going to sell whatever you're making the most money in. So if you have margin calls, you sell your emerging debt and you cover your margin. I had friends calling me on a personal level telling me they've had to do that. And they were unhappy to do it, but that affects bond prices. There are two more elements that I think affect bonds. First, we already saw today, there are going to be downgrades because the rating agencies, even though they have been named and shamed since the last crisis, haven't yet been able to predict the future. And somebody should give them a crystal ball. And it's a very difficult business, right? And they couldn't have predicted this. But they will start downgrading countries and companies. And so the last effect that I can see on bonds is we're going to have sovereigns and corporates, very importantly, stretched without the ability to pay their dollar debt. And this is where it can get quite complicated, right? Now, I mentioned that last year emerging debt did well. Well, this year, emerging debt at the index level actually had been doing quite well. Relatively, right? The MB Global is down about 15% year to date. Well, that's nothing compared to the 29% or 28% in US equities, right? The corporate index is down about 11. Now, I would say that that's not a real number because there are a lot of issues that just will not trade. And at the sovereign level, a lot of people use those sovereigns as a proxy for trading the market. So they will hit wherever they have liquidity, and you get liquidity in sovereigns. So I would say that the number on the corporate side is probably, if not down 15 on the year, it's probably down even more. Again, we can't look at only indices, but this is going to give us a little perspective. Local currency, I don't think it's even worth talking about. Local currency has been hammered, and it should, because in the old days, emerging market countries defended their currencies by hiking interest rates. That way, they were able to keep inflows, and that helped them of foreign currency, of course, right? Turkey is a typical example. Brazil was that way for a long while. But these days, countries have changed their strategies. Brazil's interest rates are not at zero, but they're significantly closer to zero than they were when they were 17, 18%, right? So I would say that local currency element, even though you may not be a dollar bull, is not the best trade to be in. So on a relative basis, there's been quite nice outperformance from emerging debt as a whole, right, compared to other asset classes. So it's done what it's supposed to do, which is to add some nice diversification, a globally diversified portfolio. Now, I think the question that everybody is interested in hearing is what's going to happen now, right, with emerging debt. And I used to have I used to say I have a crystal ball. It's actually in front of me, but I can't read from it. So it's a little difficult. I mean, sometimes it's like reading my dog, it doesn't work. So the only way to look at this is to think about the past. The historical perspective is interesting. In 1997 and 98, when we had the Asian and Russian crisis, liquidity just evaporated, right? And that had to do with the fact that countries just went overstretched. So this crisis will definitely have some of that. In 2001, we also had an interesting element that I believe is present at the moment, which is that you've got all of these private equity businesses. I've been approached by 2 or 3, guys, you've seen these people. They're hanging out at WeWork. They tell you they've got a fantastic business. They're over leveraged, and they're looking for a little financing rather than selling equity. Rather than borrowing money, because they need to get money to survive, right? And God knows how they've been surviving. I think some of that is going on these days. There'll be lots of losses in those businesses, especially after not working for a couple of weeks or let's say even months, which is what might happen. In 2008, I think the crisis was different. I mean, people in the market were really scared. Lehman was not a nice picture, especially if you had friends there. And we haven't hit that level yet. The banks seem to be doing well with all the trading. I think that the element of 2008 will be a little bit less important in this crisis. However, it will depend a little bit on the length of the crisis, and this is where I guess my big point comes in. This crisis will depend 100% on how long the shutdown lasts, right? So that's number one. Number two, it will depend on IMF support for emerging countries, right? And why do I say that? Well, the IMF has already come out and suggested that it will help countries, especially in Africa or even some of the poorer ones, to help them get through, bridge the gap until things recover. And I think it will do that. It probably will be a little bit slow. Now, the third point is nice. It's QE. I think definitely they have used all their bullets. And I would say here, it's an expression that I don't like, but the devil is in the details, right? We've had in the States a $2 trillion package, right? And just to put it in perspective, $2 trillion is equivalent to 10% of US GDP, right? So if we're thinking, even if we're Goldman and we think we could have a quarter with negative 25% growth, well, that's still not going to hit the 10% that's being put in the market. And Trump, in order to get reelected, will probably try to get a little bit more, right? I think he should. So I think the market is extremely negative. It's overdoing. And I think QE at some point, especially when we put these numbers into perspective, will provide a nice level of support. Now, again, it all will depend on the duration of the shutdown, because if you can't pay your bills, the question is, how do you do? Well, I think meanwhile, we're going to have lots of illiquidity in markets, all of them. I watched equity markets last night. I went to bed. The U.S. equity markets had gone down over 4%. During the evening, it was up over 1%. While we were preparing for this call, the claims number came out at a record 6.6 million claims. I was expecting something higher, but okay, it probably come next week. And so we see that we see the lack of liquidity affecting markets every day. It creates volatility in both directions. I think we're going to have a moratorium in many areas on dividends and coupon payments, and I think that's healthy. If somebody owes you and he can't pay you, it doesn't mean he has to go bankrupt, especially if he's a country. He'll probably delay his payment for a little while, and then when things go back to normal, he will be able to repay you if you're a country. At the corporate level, I would say it's a little trickier because some of these corporates will break, and we already saw some in the oil sector or in the shale sector in the States, and I think that's only likely to get worse. And there are a lot of credits that are not healthy and that seemed healthy up to now. So I would say that's a minefield that I wouldn't like to be walking on. My opinion, so this will happen in a near term, right? Now, what do I think is the outcome for this? I wouldn't say we're going to have a V-shaped recovery because I still cannot tell how long the shutdown will last, but it will be between a V-shape and a Nike swoosh, for lack of a better word. And I think it will happen. I don't think it will be years. I think it's just a matter of turning the engine back on. And if people are furloughed, then it's just a matter of getting them back. I think there's one interesting element to all of this, which is there will be an incredible redistribution of wealth. And we just have to think about somebody who lives on a week-by-week salary and an investment banker who's got savings, right? The investment banker can probably last a few decades. But that guy who lives on a weekly basis, he eventually is going to go belly up, and we're going to have to fund him. So it may mean eventually that all of this support is going to lead into higher taxes, or what we had already been seeing, people going on the streets and protesting. And, I've got friends who are buying guns. I've got friends who are getting cameras. They're getting a little bit worried. In fact, they're even storing food in two different houses in case one of them gets invaded. So I see that, and I think that's something that I only heard so far coming from, I think, the Atlantic. I think it will be the end of complacency. All of this quantitative trading, the debate between ESG and SRI, I think is going to have to be made more clear, because at the moment it's all over the place. And there are a lot of people who don't really follow it. And I think a lot of the benchmark hugging is going to change, because if you're buying the benchmark and people are selling the index to hedge their positions, well, you're going to have a little problem, right? So it will see we will eventually see the market recovery. In the near term, it will definitely be driven by technicals. And I wouldn't ignore the issue of fallen angels. In 2008, we had issues like that in the mortgage sector. I'm not sure if it's going to happen to the same extent. Probably not. But it may happen in a lot of the corporates that people consider safe. To give you just an interesting example, the other day somebody suggested I buy Petrobras bonds. And I thought, well, it's oil. It's in Brazil where everything supposedly is all right for now, but we don't know, right? So I think it will be quite tough. If I had to make a prediction on the end of the year, well, I already kind of did that we're going to eventually come out of it. I think it will have to happen slowly, and it will probably happen within the next quarter. I don't think we're going to be under shutdown for longer than a quarter. I think the global economy can't deal with that. We have the paint trade, which is up, because if any day of the week somebody comes up with a magic formula to fix this, you'd better be super long, because markets are going to fly out just like they did last week. So I'd say this is a very difficult market. We could end up the year positively, but it will depend a lot, going back to my first comment, on how long it takes for the shutdown to happen. That's it.
Well, thank you very much, Raphael, for this very comprehensive review of EM and implications for that market. Before I open the floor again to potential questions, just to remind everybody that this obviously this is not an investment recommendation. The views that were expressed today are the views of the three advisors, independent advisors. and this is not research. Thank you very much for that. If anyone wants to ask a question before we finish the call, there's over 30 people who have participated today, and thank you very much for all of you for joining us. If you have a question for one of our advisors, please raise your hand electronically, and then introduce yourselves. Otherwise, we will conclude this session. And again, thank you very much for joining, and we're looking forward to having you at our next webinar. Let's give it a few minutes. Well, Eugene, GJ, and Raphael, you're all three unmuted. Thank you again for joining us today, and have a good day, everybody, and good luck with the next few weeks, considering the current situation. I hope you and your family are all healthy. If we can help you with anything else, please reach out to me, mg@reachx.co, and we'll be happy to help. Bye. Thank you, GJ. Thank you, Eugene. Thank you, Raphael.
Thank you, everyone.
Thank you.
Thank you, guys.